These are in listen-only mode.
All right, everybody. Thanks for joining me here. My name is Ryan Herbert. For those of you who don't know me, I am one of the owners of ProStatus Financial Advisors Group. Going to be trying something a little bit different today, so I ask you to bear with me. I've got a new setup here in my home office. I do have my kids at home, so if you hear a noise in the background or you hear a big bang, that's because I can hear my youngest daughter is directly above me upstairs. If you have questions, please feel free to type them in as we go here. I do include a link down there in the chat box. If anybody wants to set up a one-on-one web appointment, and I think that was one of my kids trying to walk in the back door on me there. If anybody wants to set up a one-on-one web conversation, because right now my offices are actually closed to all walk-in traffic at this point. We're doing everything electronically. I included my Calendly link there. You can just go on there and find a time that really works for you, and then I'll reach out to you to contact you. To send you the appropriate links. We can do it via Zoom meeting, GoToMeeting, Join Me meeting, all the different various types of software that you want to use. We can go ahead and utilize that. All right, let me just pop some stuff out here so that way I can see everything that's going on. I'm going to try and keep this as short and sweet as I can. I don't want it to be too cumbersome or anything like that. If there's any specific questions that I don't think are appropriate for me to address for everybody, I will just let you know. And then we can set up a one-on-one phone call or one-on-one webinar appointment, and we can discuss your specific situation from that point on out. All right, so let's go ahead with this. And if the phone rings like it's ringing, my wife has been gracious enough to let me invade her home office in this time. So occasionally the phone might ring, so just bear with me here. All right, so this is me. Like I said, my name is Ryan Herbert. I am a financial planner and tax planner here with ProStatus Financial Advisors Group. I have been featured in the Baltimore Magazine. I've been featured by Forbes. I've been ranked 5-star wealth manager in the Baltimore, Washington region for the past 7, 8 years now. I was actually just ranked this past year by Forbes as the number 26 financial advisor here in Maryland. I do have an article, feature in part of an article in the What's Up Annapolis, What's Up Anne Arundel County, What's Up Eastern Shore magazines. It's this month's issue. Mike and I have a ongoing radio show on 105.7 The Fan, and that's Saturday and Sunday mornings, and then again on Sunday mornings and Sunday afternoons on 680 AM WCBM. This is just our little disclosure here. Everything is really for informational purposes. Some of the things, I don't really talk about many specific investments in here, but basically the bottom line is, I am a tax preparer. I am a tax planner. I don't refer my clients out to any other types of professionals here. But before you take any of this advice that I'm giving you and you try and implement it yourself, please consult a tax professional or an investment professional before you actually do anything of this yourself. Okay, so really the goals, talk about the Tax Cut and Jobs Act of 2017. We are now in the second year of this tax plan. This current tax rate, this current tax act goes until the end of 2025. We're going to talk about some ways that using proper tax planning, we can have some pretty significant effects on your personal income tax and retirement income streams. A couple tools and strategies that we can use. This is not meant to be political. really just talk about the policies that are in place. Facebook actually shot down one of the posts I did because I used the word political and act in there. They didn't believe that I wasn't going to be talking bad about the current government or anything like that. So there's no politics that really come into this here. So the Trump tax plan, there's good things about it, there's bad things about it, and there are things that are just kind of okay and boring that I'm really just going to skip right past some of the things I'm going to talk about. What's really important, because this is a webinar, I am going to skip over some information, and just give you a kind of 10,000 foot view on some things that I don't think are that appropriate for this type of setting. The biggest thing is that the tax law, the particular rates overall, they dropped. So we can see here, your 10% rate drop, the 10% rate stayed 10, the 15% rate went to 12%, 25 to 22, 28 to 24. Basically every single tax bracket saw a drop in percentage. Not only that, but what they actually did was they expanded how much income will actually fit inside of each of the tax brackets. More importantly, you can see here in our in this 28% tax bracket, it used to be 153,000 up to 233,000. So under the new tax law, that tax rate dropped from 28 to 24%, and now instead of capping you out at 233, it caps you out at 315,000. So, about almost $80,000 more income you can fit into this particular tax bracket. So this really provides us with a fairly large opportunity to do tax planning for most people, because most people in the state of Maryland, most of my tax clients and my investment clients really fall in kind of this line and below. So it gives us the opportunity to work inside of these tax brackets over the next 5 years before the tax rates change and we go back to this and they essentially shorten up those tax brackets again. What it actually looks like and what it is that we do, we'll get into that. All right, so this is a good thing that this is what they did. They lowered the tax brackets. For some people, it didn't feel that way when we did the taxes back in 2018, simply because of some of the other things that changed along with these tax rates. Really what I'm doing when I'm looking at your tax return is I'm looking at what is called a tax map. It really helps visualize how much income falls into these particular tax brackets. You can see there's 0% and then it jumps up and then it starts to kind of go up until we get to that highest possible tax bracket there. Okay. Long-term capital gains. They did change these a little bit, but that's kind of boring. That's not really a whole lot of area where we can take advantage of some of the new tax laws. Although it is interesting to note that right now, because of what's happened in the stock market, if you have a lot of highly appreciated assets, something that has a large capital gain inside of it, now might be the time to realize some of those gains, because they have fallen in value. If there's been a reason you wanted to get out of these positions and invest in something else, if you're too heavily invested in Apple stock or Microsoft or Disney or something like that, now might be the time for you to sell those stock while it's at a depressed level and invest into something else. If you've had your eye on some other stock that you want to buy, or you just want to divest your interest in that, now might be the best time to do so, because we have such a depression in the market. That way you can take advantage of it now, buy something else, whatever else that you might be interested in, and have the participation on the upside of the market on that particular stock. Just one thing that I'm having those conversations with my clients that have those highly appreciated assets, if we have not already started doing something about that so far. Here's just that tax map for the long-term capital gains and dividends. It really is just showing where the tax rates fall. 0%, 15%, and 20% there. So what really changed for a lot of people is the amount for your deductions, the amount of standard deduction. They increased everything. They essentially doubled it. For a married filing joint couple, it's $24,000 for 2018. It was in 2018. It's gone up just a little bit so far this year, and it was $12,000. It's gone up. Once you're over age 65, they have increased that number. They gave you a little bit more, just like they used to give you a little bit more personal exemption once you reach over age 65. They did the same thing. You know, it's good if you have not had a mortgage or you've paid down your mortgage and you've been taking that standard deduction for a while. You really saw the benefit. For those people who were just over the normal standard deduction amount, this kind of hurt them simply because when we used to be itemizing your taxes on both the Fed and the state, now if you're taking that standard deduction on the federal side, it makes you take that standard deduction on the state side, which is not that beneficial of a thing to do. So it's always a numbers game when it comes to doing our clients' taxes. Here's that additional standard deduction for if you're over age 65 or blind. $1,300 extra for a married filing joint couple, $1,600 for a single person. Another thing that changes, if you are taking care of an elderly parent, it allows you if you're single, it allows you to claim your parent as a dependent, even though they might not be living with you, if you're providing that support for them. So it did open up a couple things there. A lot of questions that I got was about the mortgage interest. Basically, if your loan, how it reads now is if you had a loan before December 14th of 2017, if as long as they limited your interest on loans up to $1 million now, going forward, if you're buying a new house, if your mortgage is over $750,000, they limit the amount of mortgage interest that you're actually able to deduct. They kept it in place. They gave us a high dollar amount, which is a good thing. If you're buying a house that's over $750,000, it's something you need to be cognizant of when you go to make your down payment. General deductions pretty much stay the same. I think everybody realizes that the charitable deductions are not a dollar for dollar reduction in taxes. For every $1,000 that you donate to charity, it saves you between $250 and $350 in taxes, depending on what tax bracket you're in. So what I tell most of my clients now is it's still very important to keep track of all those charitable donations. It's still very important to keep track of your medical expenses. But really the whole purpose of doing the charitable donations is because you're doing it out of the goodness of your heart, not so much just for that tax deduction. Although it does play a fairly large portion of a lot of people's itemized deductions. One thing that was very bad that impacted pretty much everybody here in Maryland, because Maryland does have a fairly substantial local income tax and property taxes. Most people's property taxes in Maryland, if you're in Howard County or Montgomery County, you're looking anywhere from $6,000 to $8,000 to sometimes even $10,000 in property taxes. What they did was they limited the amount of taxes that you can deduct, the state and local income tax. They capped that number at $10,000. So if you are normally paying $14,000 or $15,000 of Maryland state income taxes out of your paycheck, plus you're paying $8,000 in property taxes to state of Maryland, they capped you out at $10,000. A lot of my clients lost anywhere from about $8,000 to $15,000 of tax deductions just in this one section alone. So this really hurt a lot of people. This is what California and New York and New Jersey and Maryland have all been fighting because of the big deduction that they're losing, because it's typically a higher property tax area. because they increased that standard deduction, they got rid of the personal exemption. So you used to get $4,050 per person living in your house. They got rid of that. That's no more. So when it when people used to say, you should have kids because it's great, you save money on taxes, it's not so much the case anymore because they took away these personal exemptions. Skip something. No, I went right there. When you retire, everything changes. All the rules change because there's different things on the tax return that impact other areas of your tax return. Because you have all of a sudden you have your required minimum distributions. You have capital gains if you're realizing some of those stock sales to generate income for yourself. You're paying Medicare. People might be doing Roth conversions or taking rather large distributions out of your IRAs because those IRAs have been the single biggest asset that you have been putting money into over these years. You've been saving. And now when you retire, you need to turn them onto income streams. So it's a matter of how we can create income streams in retirement and keep it as tax efficient as possible. This is a really fun surcharge tax. If you make too much money, you get charged an extra 3.8% tax on investment income. They got rid of the personal exemption phase out, and they got rid of the itemized deduction phase out. So those things kind of go away. And then there's always AMT. It's pretty much, AMT is very confusing for a lot of people, and what we always try to do is try and minimize the amount of income that you're realizing so we can stay out of that AMT number there for you guys. And most importantly is Social Security. You do pay tax on your Social Security benefit. You don't pay state tax here in Maryland on your Social Security benefit, but you do pay federal income taxes on your Social Security. And how much money you're making in Social Security and how much other sources of income that you have is what determines how much tax you actually pay on Social Security. So this is a little bit outdated here, but your RMDs, because they changed the tax law at the end of this year, as of December 31st, 2018, the new RMD number, the new age for an RMD is 72. If you had not yet turned 70 and a half prior to December 31st, 2018, you do not have to take your RMD until you reach age 72. It's a super fun number to calculate. The IRS has a fun table that says here's the number based upon your age. So you take the December 31st value of your account, look up that number, the IRS says, divide by it, and that's the number you have to come out. It is about 4%. Every single year. It's not a hard, fast 4%. You have to do the calculation, because if you don't get the number right, you don't take out enough money, the penalty that the IRS charges you is 50% of whatever you didn't take out. So if your RMD was supposed to be $5,000 and you only took out $4,000, that's $1,000 that's left. The IRS charges you an automatic 50% penalty of that $1,000 because you didn't take it out. So that's a $500 penalty just because you didn't take out the right amount. So it's very important to make sure you know exactly how much needs to come out of your IRA for RMD purposes. Once again, they changed the rules as of the beginning of this year. So the new RMD number is age 72. This was the number for age 70 and a half. If you had a $500,000 IRA at the end of the year, for age 70 and a half, that number was 27.4. So the amount that has to come out was $18,248. That number changes every single year because your IRA balance changes every single year. It goes up in value, it goes down in value. More recently, most people's IRAs have gone down in value. And every year you get older, this number right here changes every single year. That's kind of boring. Here is the life expectancy table. Every single year that number changes. So for most people now, the new number is 25.6 is what you start with. And then every single year you can see this number gets smaller and smaller. So a larger dollar amount comes out every single year. If you are charitable minded and you want to donate money to charity, there are ways that we can take your RMD and donate it directly to the institution that you want. Then you can avoid paying taxes on your RMD. The typical scenario is once you reach age, call this 72, you take your RMD out, you pay tax on that money. So if your RMD was $5,000, that same scenario, it goes on to your tax return. You pay tax on that $5,000, then you're giving that money to the church. You're paying tax on this distribution, so you're not actually leaving them $5,000. You're giving them $5,000 less the applicable taxes. Versus if you just did a qualified charitable deduction, you can take that money out of your IRA and send it directly to that institution and send that money over. And I apologize, I left my cell phone on, which is a big no-no. But that's the school probably telling us that you're going to be suffering even longer than you thought you were. So, capital gains, mutual fund pass-throughs. This is a big thing. Most people are going to be seeing this happening to them at the end of the year this year, simply because this happened in 2008. So if you think of your mutual fund as a big basket of stocks and bonds, every single time someone gives that mutual fund manager money because he's doing really well, he has to go out and buy stocks and bonds inside of his mutual fund. Every single time people say, I want my money because the market's doing bad, I want to pull everything out because the stock market has just dropped 35% over a 2-week period, he has to go sell those stocks and bonds in there. Well, the stock market over the past 11 years has really done nothing but basically go up. We've been in this 11-year bull market. So all those stocks and bonds that he has inside of that mutual fund have some gains inside. So when he sells those things off, there's capital gains that happen. If you have your mutual fund, even if you didn't sell your mutual fund, at the end of the year, on that 1099, it's going to say, here's your interest, here's your dividends, and oh, by the way, here's your share of all those capital gains that we had to realize because other people were selling their mutual funds. So it's something that you want to be cognizant of, is there will be tax consequences because of what happened, even though you didn't sell anything. You have to rebalance those mutual funds on a regular basis to stay properly diversified. And your long-term capital gains can trigger ordinary income tax on your Social Security. This is one of those things that can all of a sudden make your Social Security become more taxable. It can jack up your Medicare premium because you made too much money, even though you had on your mutual fund all year long. This is not a good thing. This is like what I said, the Medicare premium. The more money you make, the higher up your Medicare premium goes. So for Part B, if you make under $170,000 a year, it costs you $1,608. If you make anywhere from 170 up to 214,000, your premium jumps up by $156 a month, and so on and so forth. So if you're going to have a year where you're going to realize a lot of income, whether you sell a business, you sell a whole bunch of stock, if you are working for most of the year and then you start claiming Medicare, these are things that can cause those Medicare premiums to really skyrocket. There are ways for you to fight this adjustment, the IRMAA adjustment that they make. It's very rare that people ever get the exceptions. I think I've had 6 or 7 clients fight this, and I think I've maybe 1 or 2 have actually gone through with it and they realize it, but that was a very specific situation for them. Okay. Roth IRA conversions and contributions. Frank asked me a pretty good question here. Is it worth it to move money from your regular IRA or Roth IRA, or take money out of an annuity and put money into a Roth. So really, is it a good idea to do Roth conversions? Well, right now, Mike and I have been talking about ever since they changed these tax laws, because they took those tax brackets and they lowered the amounts a little bit. What they did, like I mentioned before, is they added, about $80,000 worth of income that you can add onto that 24% tax bracket without taking you up to that next level. So this is the perfect time for you to take money out of your IRAs at this point, pay the tax on it now, while tax rates are the lowest that we've seen in a while, keeping in mind that the Bush tax cuts were still pretty low. We pay tax on it now, get it over to a Roth IRA, and let all that money grow tax-free. More importantly, because IRAs have fallen in value, we have these depressed account values. If you're just saying, I'm going to hold on, I want to put the money in the market for when the stock market does come back, or if you moved everything to cash right now and you haven't decided when you're going to go back in the market, now is the perfect time to do Roth conversions, because we're converting over smaller dollar amounts. We're paying tax on smaller dollar amounts while the taxes are low. You move it over to that Roth IRA. You invest it however you want. You can put it back into the market. You can remain conservative and wait for that point at which you're going to jump back into the market, so that when the stock market does rebound, when we do get out of this COVID-19, this basic worldwide economic shutdown, slowdown that we're seeing right now, when the stock market does rebound, all of that growth that you would typically see inside of your IRA if you just held on, if it's inside of an IRA, yeah, it goes back to where it was, but it's all still 100% taxable. We pay the tax on it now, while tax rates are low, while account values are low. Put it right back in the same exact thing that you were invested in before. If you were in Apple or Google or Facebook or UPS or whatever it really happens to be, or the portfolios that Mike and I manage for our clients, we're simply taking those positions from one account to the other account, having it invested the exact same way, so that way when the stock market does come back, it rebounds. Now, all of that growth that you have there is now tax-free. Tax-free, zero taxes. There's nothing so awesome as tax-free money. So that when you take that money out in the future, when you retire or when that RMD was supposed to happen, now all that money that's coming out is all tax-free. What they did with the tax law is they eliminated the Roth recharacterization, which basically means if you do a Roth conversion, there's no going back and changing your mind where you used to be able to do that. The contribution limits for how much you're allowed to contribute to the Roth IRA, and the amount of money that you can make to still contribute to an IRA, those still stay in place. The number one thing to remember is that there is no limit to the amount of money that you can make and do Roth conversions. There is no limit to the amount of money that you can convert over. You can make $1 million a year and do Roth conversions. If you have $1 million in your IRA, you can convert all $1 million over in 1 year. I don't know why you would do that, because you would actually get crushed in taxes, but there's the ability to do so. Net investment tax, basically, there's an additional tax on your investment income, your capital gains income, your interest payments, ordinary income, annuity payments, passive business income, and rent. If you make over $200,000 as a single person or $250,000 as a joint couple, you pay an extra 3.8% on top of that. Question coming in is, can you convert money from an annuity that is an IRA over to a Roth? The answer to that question is yes, you can do that, but you have to convert 100% of that money at one time. So if you have $500,000 inside of an annuity that is an IRA, in order to not ruin the terms of that contract and not blow it up and not give up the guarantees or pay surrender charges or anything, you have to convert all $500,000 at one time. Which is why when we were doing some of what we had been doing over the past 2 years with our clients, using those annuities as bond replacement, we took that money that we knew we were going to convert over and we broke it up into smaller policies. And we convert 100% of those policies over a time period. So if you had that same $500,000, we might have taken it and broken it up into 5 policies of $100,000 each because that was the magic number that we we're going to do for Roth conversions. We convert one over every single year so that way you're not doing it all at one time. So yes, you can convert out of an IRA annuity into a Roth annuity. You want to make sure that you understand the terms of the contract, that it's not going to ruin it, because that's the biggest thing. When you buy annuities, you're buying them for a specific purpose, whether it's principal guarantee, whether it's income for life, or whether it's some type of death benefit. And think about it this way: if you have those IRA annuities and you have those those guaranteed income riders, where it's going to guarantee you at some point in the future, 5, 6, 7, 8, 9, 10 years from now, it's going to start paying you an income stream of $2,000, $3,000, $5,000 a month, whatever that number is, whatever the number is that you calculated that you wanted to have. Well, if it's all in an IRA, all of that money for the rest of your life, every single time it sends you a payment, is 100% taxable. That $1,000 a month is 100% taxable. If you do those Roth conversions, so you use money from a Roth IRA to buy one of those annuities, you can pay the tax on all of it now. Pay tax on all of it right now. That way, the distributions that you receive out of that thing on a monthly, yearly basis for the rest of your life, because those things have those riders attached to them. It says no matter how long you live, you can be 115 years old, we're going to pay you $1,000 a month, or whatever that number happens to be. Well, you can take out all of your money because you've already paid tax on it, so you get your money back. And then once you start living on that insurance company, all the money that they're paying you from there on out is 100% tax-free. So it's a way to leverage the money that you have, because if you have $300,000 in that annuity IRA, it takes about 15 years for you to get your money out. Once you get past that 15-year period, you've taken out all your money, all $300,000 that you gave that insurance company to guarantee you this income stream. You've taken it all out, and now you're living off the insurance company tax-free. So there's very useful things that we can do with those annuities. If you have existing annuities, feel free to give me a call, shoot me an email. We can talk about your specific situation. Not a fan of the net income tax because it does ruin the planning for a lot of people. AMT, I'm just kind of going to skip over this because this is something I really can go into more in person with some demonstrations. Basically, it's an extra tax. The amount of tax that you pay on your Social Security is all dependent upon your provisional income. So to figure out how much tax you're going to pay on your Social Security, you take half of your Social Security benefit, plus all the other income that you make, plus your dividends, your capital gains, even that tax-free muni bond income, if that goes on there too, non-taxable interest. You add all those things together, it can really mess up your tax planning. Here are the numbers. I'm going to work on basically just these numbers here. If you take the sum of half your Social Security plus all your other sources of income, money that comes out of your IRAs, your pensions, dividends and income, interest, if the total of that number is over $32,000, you're going to pay tax on 50% of your Social Security. It's not a 50% tax, it's 50% of your Social Security benefit taxed at your ordinary income. So if you're making $2,000 a month in Social Security, you're going to pay your ordinary income rate on $1,000. That number starts to go up. That percentage goes up a little bit as you go between 32 and 44,000. Once you get over $44,000 of provisional income, you pay tax on 85% of that Social Security benefit. This is where a lot of fun tax planning can really come into play. I have a situation that I'm going to show you that I actually did with some of my clients that's worked out pretty well for them so far. So, if you wanted $50,000 a year of income, this is really just showing us how Social Security can become taxable to you. This first scenario, they're going to have $20,000 a year in Social Security as a married filing joint couple. and they're going to take out $40,000 a year. So this is $60,000 a year of income. So we take half of their Social Security, which is $10,000, plus 100% of their other income, which is this 40. So the provisional income is 50,000. So they're over that $44,000 number. So these are the calculations that we do. They're going to pay tax on $9,000 of their Social Security, and then they're going to pay tax on another $2,100 of their Social Security because it is a laddered thing. So they're going to pay tax on, of the $20,000 of Social Security that they've received, they're going to pay tax on $11,100, which is a 55% taxability rate. This is the same type of scenario, but with different income sources. This is saying that they're going to receive $40,000 in Social Security. Now, I realize you cannot truly choose how much money you're receiving in Social Security, but with having the right plan in place, these are some pretty cool things that we can do. So this is that same $60,000 worth of income. This time they have $40,000 of money coming in Social Security. They're going to take out $20,000 out of their IRA. So instead of having $50,000 of provisional income, we take half of the Social Security, which is 20, plus the $20,000 IRA number. That gives them $40,000 of provisional income. Well, they're going to pay tax on 50% of their Social Security benefit. So the total taxable benefit that they're really seeing here is 10%. So 10%, paying tax on 10% of your Social Security versus 55% of your Social Security here. This is really what tax planning really looks like. So, here's where it looks like. The first scenario, $40,000 coming to the IRA, $20,000 coming out of Social Security. They're going to pay tax on $11,100 of their Social Security. We have their $40,000 IRA. So their total taxable income is $51,100. We're going to take away that standard deduction because both of them are over age 65 at this point, so they get that extra number. So their total standard deduction is $26,600. So their net taxable income is $24,600. This is the 51.5 minus the 26. The total federal income tax they're going to pay on this number is $2,571. A little bit more than 10%, still not bad. Same scenario. Their total taxable Social Security. Now, mind you, this number here was $60,000 a year. This number here is that same $60,000 a year. Instead of having all this money coming out of the IRA, we're only taking $20,000 out of the IRA. So the total amount of taxable Social Security is $4,000 plus our $20,000 a year of Social Security income. So their total taxable income for the year was $24,000. Take away their standard deduction amount, $0 of taxable income, and you cannot pay tax on zero. So this is $60,000 a year tax-free, $60,000 a year, and I apologize, my handwriting is typically terrible, and using a mouse it's even worse than normal, but it's that same $60,000 a year, but having that tax aspect, having somebody who understands how the taxes truly work as far as when you're taking money out of your IRAs, how it can impact your overall tax return. This is a case study. This is John and Jane. These are not my client's actual name, but this is a true scenario here. So John and Jane, they're both married filing joint. They're both over age 65. They have $60,000 a year of combined Social Security income, $15,000 of long-term capital gain. They have a $15,000 requirement of distribution, and they're receiving a pension of $30,000 a year. Really, what happens here is their tax bracket, and if you're going to bear with me here, I got to get into my notes here because this is really saying it. So this is their tax bracket, and this is what's happening because of how much money they're taking out of their Social Security. What is really happening is the extra taxes that are getting piled on because of the money that they're taking out of their IRAs and their Social Security. It's jumping up their tax bracket. They're paying a large amount of taxes on a very short dollar amount. Really, what it looks like, it's 49.95. Basically, if you take out too much money from your IRA, it can trigger extra portions of your tax return to be taxable to you. So what happened is they took out an additional $1,000 of their IRA. Now they're in that 12% tax bracket. So that was $120. Because they took out that extra $1,000, it triggered an extra $850 of their Social Security to be taxable at that 12%. So that was $102 in extra taxes on $850, which causes more money from their capital gains to be taxable again, and the 50% capital gains, which is an extra $277.50. So by taking out $1,000 more from their IRA than they should have, the extra tax they paid on this $1,000 was $499.50. This is a pretty complicated little scenario to kind of get through to this webinar, but really it stresses the point of working with a financial advisor, working with a tax person who understands how the tax return works, how taking money from certain sources of income impact the different areas of your tax return. This is Bob and Betty. They have $50,000 a year of an income. That's the number they want to live on. So their current plan was to take out $50,000 a year out of their IRA because they're only 62. They're going to wait to claim their Social Security because every year they delay taking their Social Security, it does increase. From 62 to full retirement age is about 6% per year. Once you reach full retirement age till age 70, it's about 8% per year. So here is kind of the tax software that I go through with my clients when they come in and see me. We talk about how we can certainly do tax planning. This is really what my view looks like. I wanted to show everybody how it really looks. So this is Joe and Jill. Here's our date of birth. Once again, these are not their names, not their true date of birth, but this is a real scenario that we went through. So here are their various sources of income. They said, we're going to retire. We want to have $50,000 a year of income to live on. We're going to delay taking our Social Security, just live on our IRA. So here's what that really looks like. There's that 50,000. So using that $50,000 of income essentially puts them in that 15% tax bracket. Because the tax brackets are laddered, meaning you pay no tax on, up 10% on a certain amount, and then 12, then it goes up to 15. So we have their 50,000. We take away their standard deduction of 24.4. That brings their overall taxable income down. So on $50,000 a year as a married filing joint couple, their total federal taxes is only $3,304 a year, which is an effective rate of 6.61. Because you don't pay tax on 100% of your income in whatever tax bracket you fall. It's laddered. Your effective tax rate is actually a little bit less. So this was their plan when they came to me. This is what they thought that they wanted to do. So I said, all right, let's look at tax planning. Let's look at your other sources of income. Maybe let's look at taking Social Security earlier and seeing what we can really do with your taxes. So what we said was, let's turn your Social Security on early. So for them, that number for them was $35,000 a year in Social Security. Their income needs didn't change. They still need, sorry, one of my daughters just ran into the room. They still needed that $50,000 a year of income, so they needed to take out $15,000 of their IRA to meet their income. Because those provisional income things happen, because Social Security is only taxable once you get over a certain dollar amount, because of how much money we took out, I think this is going to advance me. Yeah, this makes it a little bit, no, hold on, back it up. Because of how much money they took out of their IRA, we kept their provisional income low enough to where they weren't going to be paying taxes on their Social Security. We only triggered a little bit of it to be taxable, but then we take away all that income that's taxable using their standard deduction. So that same $50,000 a year that they were going to pay $3,304 in taxes on, which is not that large of a number, we're able to just simply reduce completely to zero. And this is really the benefit of using tax planning and someone who understands the tax code. Let's take that same scenario and add a little bit more income, because I'm always trying to figure out on the tax return, how can I use this tax mapping software to generate the most amount of income that I can while keeping taxes as low as possible. So in this particular scenario, I figured out that the magic number for them to take out of their IRA was $19,000 a year. That's the number I can take out with them having $35,000 a year of Social Security without causing any of that money to be taxable. So, some tips and tricks. Everybody wants to do personal tax planning. You want to make sure that your withdrawals can be done at the lowest rate possible. You want to think about having your money in buckets. You want to get as much money in that tax-free bucket as possible. Having money in the tax-free bucket, in Roth IRAs or cash value life insurance. Those are two sources of income that people don't really think about as far as how can I generate that tax-free income. You want to sit down with your tax professional, either you want to sit down with Mike or myself, or your tax person, and talk about, let's figure out the right number for Roth conversions for me. Let's look at using money that I have sitting around in maybe my checking account or my savings account, or money I have sitting in a brokerage account. Let's look at that. How can I use cash value life insurance to generate tax-free streams of income for me in retirement? A lot of those cash value life insurance policies that are out there are indexed life policies. So they eliminate the downside. So when the stock market drops 20, 30%, you don't lose anything. But then when the stock market goes up, you get 100% participation, or maybe they give you a cap, or maybe they give you some multiplier of the market, whether it's 110 or 130% or whatever the stock market does. But there are ways to use those cash value life insurance policies to generate tax-free income. The Secure Act, that's one thing that everybody really needs to be cognizant of. I talked about them increasing the RMD age from age 70 and a half to age 72. So that's a big thing. Another thing that they did that most people don't really realize, and this kind of makes it more important to do Roth conversions, is there used to be the ability for those people out there that when you pass away and you leave your IRA to your children, your nieces and nephews, your grandkids, they used to be able to take that IRA and stretch out the distributions that they take out over their lifetime, creating what's called a stretch IRA. So they take a small amount of money out every single year because that RMD is still there, because the IRS wants their share of that IRA. They want you to pay tax on it. So you used to be able to take it out in small dollar amounts over their lifetime. Now what the IRS has said is all of that money inside of your IRA has to come out over a 10-year period. So if you have $1 million inside of your IRA and you're leaving it to your kids, all $1 million has to come out over a 10-year period. They have to pay tax on a larger amount. And that can really negatively affect their tax return, because most couples in Maryland, both of them are working. The average level of income for a married filing joint couple is about between $190,000 to about $270,000 of income. If you're going to tack on $100,000 just because that money has to come out of the IRA, that's going to throw them up into the next tax bracket. They're going to pay a lot more money in taxes simply because we didn't do tax planning. If you do those Roth conversions now, those RMDs that they still have to take out are now tax free. So that's a big portion of the Secure Act, is that aspect right there. The CARES Act, this is the act that they just passed to kind of help with the COVID-19 impact, the economic impact that we're seeing, and it's going to continue to happen because countries are being shut down, because businesses are being shut down. They delayed taking your RMD for 2020. So you do not have to take your RMD for 2020. If you had turned 72 this year, if you had just turned 70 and a half and you're going to take it out, you're waiting, you can delay taking that out, because they say now that the account values have dropped so significantly from where they were at the end of the year, nobody has to take out their RMD for 2020. The overall goal for me with my clients is all the money that we have in the taxable bucket. So this is money you have in checking accounts, savings accounts, regular brokerage accounts. All the money you have in your IRA, your 401k, your 403b, your 457, your TSP, whatever variation of a retirement plan it is, we want to get as much money as we can from these buckets over to our tax-free bucket, which is simply Roth IRA money. We want to get money over here into the income tax-free and the estate tax-free bucket, because what we're able to do over here, this is cash value life insurance. We're able to generate tax-free streams of income for you while you're alive using life insurance. And then when you pass away, all that money that you've put in there is now tax-free to the kids, because now they're getting a tax-free death benefit. There's no income tax on that, and there's no estate tax on that. So the overall goal is to have as much of your money over here. Unfortunately, what it looks like for most people is they have about 80% of their money here, 15% of their money here, and only 5% in this tax-free bucket. The idea is to get as much as we can in this direction, because it not only benefits you while you're alive, because we're generating tax-free streams of income for you, it benefits the kids in the future, because tax rates really have to go up in the future. They've been as low as we can. We've been running about $1 trillion deficit in the U.S. budget for a number of years now. Tax rates go back up at the end of 2025. I can only imagine what is going to happen because of all the tax breaks that they're doing, because of all the Fed buybacks, them cutting interest rates to zero, all the money they're giving to small businesses, to big corporations, to bail everyone out, to get the U.S. through this period, is a ton of money that we're giving out. They have to recoup it somewhere. They have to raise taxes at some point in the future. Are they going to raise taxes in your lifetime if you're over age 65? More than likely, yes. Are they going to raise taxes for your kids and your grandkids? It's money that you're leaving them if you're not going to be spending it. You're for certain that they're going to raise taxes for them. So you want to make sure that we create those plans to keep everything as tax-free as possible while you're alive and after you're gone. Those are the number one goals for us. In conclusion here, your tax plan really varies on your personal situation. What I've done here in the chat, if everyone goes to the chat, you can see it. I set up a online appointment scheduler thing here, so you can log on to my Calendly app. You can schedule your no obligation personal consultation. We'll look at your tax return. I'll look at your investments. I'll look at your estate plan. I'll tell you how much you're paying in fees. I'll tell you how much risk you're taking on your portfolio, and we'll talk about doing those Roth conversions. We'll come up with those magic numbers for Roth conversions. I'm going to tell you what the maximum pain number is for you, as far as here's how much money you can take out of your IRA, convert it over to a Roth, and here's the tax consequence. We're going to talk about all the different ways that we can create those tax-free streams of income for you. Between Mike and myself and the other tax preparers that we have over 50 years of taxes. Mike and I were actually getting into a little bit of an argument today, because I am destroying him in the number of tax returns that I have done this year versus the number of tax returns that he does. So we are actually the ones doing the tax returns for our clients. It enables us to understand all your sources of income in retirement and what impact they have on the tax return. We're doing all these appointments right now. We're doing everything over the web. They're one-on-one. You're sending us documentation ahead of time. We're coming up with an outline of a plan. Then we're going to come back and we're going to meet with you for about an hour. Typically is the time frame it takes, and we're going to go over everything that we're seeing, and it's absolutely no obligation to anyone here. Anyone may so arrange his affairs that taxes shall always be as low as possible. He is not bound to choose that pattern which will best pay the treasury. Basically, this is a quote from a court case. Really, the number one goal is to pay the lowest amount of taxes legally possible while alive and after you pass. That's the number one goal for Mike and I when we're meeting with our clients, is how do we create those tax-free streams of income for you in retirement. If anybody has any additional questions, please feel free to shoot me an email. Please note that our email addresses have changed. My email address is ryan@ProStatusFG, as in ProStatus Financial Group. The phone number, you can call the office, leave a message for me. We are closed to the public, although the office is open at this point. I'm trying to limit the amount of people that we have in our office. Typically, we like to have one staff person there at a time, just to flatten that curve, as they say. So you can give the office a call, 410-863-1040. Or if you want to schedule your own personal consultation, there is the web link. It is calendly.com/ProStatusFG, calendly.com/ProStatusFG. I set up a bunch of time in there for the next 3 weeks, as I'm probably going to be working from home for the next 3 weeks, so I do have more availability. And once the office does open back up, we're going to start doing in-office appointments again. So thanks everybody for coming. Please feel free to give me a call, shoot me an email, or set up a one-on-one consultation. Thank you for attending, and I hope everybody stays safe and healthy out there. Thanks everybody, and have a good afternoon.